Hi, good morning, everyone. It's Guangzi here. Thank you for tuning today's webinar. So today we will talk about our initiation coverage on Sembcorp Industries, as well as company sales update on Geo Energy Resources. Firstly, we'll go through the first Q results of Geo Energy Resources. Our title is temporary. Headwinds are limited. So we maintain our buy rating with unchanged target price of 45 cents compared with last time price of 27 cents. Now let's take a look at the financials. The top line revenue went up by 735%. This phenomenal growth was mainly due to the increase in coal sales volume. As you can see here, the first Q sales volume arrived at 2.21 million tons compared with last year's first quarter's less than 500k tons. And also the average selling price, the thermal coal mainly is ICI 4.2 thousand GAT. The price was the average sales price was around $40 per ton, compared with around $31 per ton in 1Q16. So here the two main bullet points here are the most important. Firstly, the management announced that they propose to redeem the midterm note earlier, and the par value of this one was 100 million Singapore dollars. So to incentivize those bond holders to vote the approval, the company will grant a consent fee of 0.5% of the nominal value. The reason why the management want to redeem the note earlier is because some of the confidence of this MTN stopped the company from borrowing from other sources, as the management aim to build a future to expand the existing coal reserves. The company needs to refinance more to fund the expansion. So that's why the management wanted to redeem this MTN earlier. The next is that the market concerns on the risk of curtailment on the imported coal to China recently. So the preliminary assessment from China was that there will be 5% to 10% drop in FY17 year-on-year of the total imported coal. However, we think that this impacted more on the price side rather than the volume side. Why? Because quite a few amount of coal miners in China are producing coal with a higher production cost. Since the purpose of this policy is to lower the coal's selling price, this will drive out some of the inefficient coal miners in China. So accordingly, there will be some coal shortage of supply. That means the coal price will actually goes up subsequently. So we think that the coal price is quite resilient because of this. And also because Geo Energy is trading through the ECTP, which is the trading house. According to the management, actually ECTP has not only the China sales, but they also have other sales channel to distribute the coal to other countries such as India and Japan and South Korea. So we think that since ECTP already secured 7 million tons of coal from Geo this year, the sales is guaranteed to some extent. So according to the management, the 10 million tons of sales target is still on track. So the rest 3 million tons of coal sales will go to domestic market. As of now, Geo has been expanding the domestic market. It tried to connect the sales channel to those domestic power plants. So next is our initiation report on Sembcorp Industries. Our title is Enjoy Your Yield as Positive Catalyst Unravels. So here is the company snapshot. We initiated with an accumulated rating with a target price of $3.50, together with the forecasted dividend of 8 cents, compared with the last time price of $3.15. The upside is around 13%. So here is the price chart comparison between Sembcorp Industries and Straits Times Index. Because Sembcorp Industries is heavily weighted in the index, so you can see a strong correlation between both. So here there are 3 investment merits that we think can drive the Sembcorp Industries price up. The first one is the turnaround awaits in India. So we'll talk about the details later. And we are still positive on the stable growth in China. So the last one is that the CEO was on board in April this year, and he addressed that he will conduct the strategic review on the existing portfolio. So we will give several options on this strategic review that may help to lift the value up from the current valuation. So here is the company background. Basically, Sembcorp Industries are operating business in 3 segments: utilities, marine, and urban development. So the first 2 are the most important segment for Sembcorp Industries. So you can see the pie chart breakdown by revenue. The utilities as of FY16 has overtaken marine, become the largest revenue contributor. So the utility side, thermal power generation is the most important segment, as it has the largest asset base and the largest capex compared with other energy solutions. As for marine side, currently Sembcorp Industries is still owning 61% of Sembcorp Marine, and we knew that the marine side didn't do well in recent years. As of the geographic breakdown, Singapore is still the main region that contributed most of the profit, most of the revenue, and China. And though China here show that China only takes up around 2% of the revenue. However, in terms of the profit from operation, India and China are the second and third largest profit generator in terms of the operating revenue. So here we will give updates on the geographic macro conditions. As we say just now, India, Singapore, and China are those three major markets that contributed most of the revenue as well as the net profit. So here, these two tables shows the power supply and demand relationships in India market. We extracted this data from Central Electricity Authority in India. So basically, the table above shows that as of FY16, the India is facing quite significant. India is facing substantial power deficit. As you can see here, all India is facing like 2.1% of the power deficit, and here the northern states, which is where is the second largest power demand region, were facing around 5% of the power deficit. So the authority anticipated that the overall deficit situation will be improved in FY16 to 17. However, in northern states, eastern and northeastern states, these three regions are still facing power shortage. So currently, those two plants that Sembcorp Industries operating is located in southern area. So the next is that here the chart shows why those plants in India is confronting to low utilization, because actually the government has been ramping up the install capacity over the past 10 years. However, the actual electricity generation volume didn't catch up with the install capacity. That resulted in lower plant load factor, which is the proxy of utilization rate of these plants. So here we listed 4 reasons why the plants have lower PLF and power shortage in all those regions. Firstly, India is facing the insufficient and intermittent of feedstock supply, because lack of cheaper coal and gas in the domestic market. Those plants, they need to export, they need to import coal and gas supply from overseas which they are subject to higher production cost. And also, some of the areas are lacking water, as those regions, they didn't have enough water reserve to provide the public usage. So needless to say, they wouldn't have the extra water reserve to support the power plants. And secondly, some power retailers refuse to supply power to those poor rural areas. As for those people who live in these rural areas, the households, they cannot afford the power tariff, even though the tariff is below the production cost. Thirdly, the power theft issues prevail. So due to the poor infrastructure conditions, like technical problems, as well as the commercial regulation, poor commercial regulations, there is quite significant amount of power losses during transmissions. And lastly, for those distribution companies, most of them had weak financial positions. That means these distribution companies, they will defer on the payment to the power generation companies, and even sometimes they defaulted on the offtake agreements or the power purchase agreements. So the next, we'll talk about the current situations in Singapore. So basically, Singapore now is facing supply glut issue. As you can see here, the chart on the right hand side here. So actually, the supply capacity is more than the demand over the past 10 years. So actually, the surpluses of power supply consisted from 2006 until 2015, and also the government increased the license generation capacity year on year. So you can see here the CAGR of the license generation capacity for this period is around 3.6%. However, the peak demand CAGR is only 2.9%. So according to the Energy Market Authority, the current situation won't be improved until 2019, since according to their guidance, there will be 700 megawatt of the capacity to be retired in 2019. That means until then, the supply glut won't be relieved in the near term. So here are the reasons why the power market is severely competitive. Since 97% of the power plants in Singapore are using gas as the feedstock to generate power, so they are subject to the take or pay structure. Means that those power plants has signed on the contract to buy the gas, so they will need to generate the excessive electricity after that. And also the vesting contract levels dropped to 20% as of last year. So these vesting contracts are the contracts signed by the local power generation companies with Singapore Power Company. So this low level of vesting contract means that those power generation companies will be more exposed to USEP, Uniform Singapore Energy Price, which is the proxy of spot price. Since we knew that the vesting contract price is much higher than the spot price, so at this point of time, the power plants are facing loss-making issues. As you can see here, this is the chart that compares with USEP and the short-run marginal cost. The blue line here shows short-run marginal cost of those power plants. You can see over the past 5 years, their production cost was below the average selling price of the spot market to the spot market. So next, we'll talk about the China's macro conditions. So here, basically, these two charts here show that the wastewater treatment in China is far from saturation, and in the foreseeable future, we still see positive growth in terms of the power plants, in terms of the number of power plants and the design capacity of the wastewater treatment. So as for the electricity supply in China, as the chart show here, so actually in recent year, the growth rate was lower but still maintained at a positive number. So we still think that moving forward, the power generation demand still have positive growth. And according to Bloomberg, recently they reported that there will be a possible consolidation of state-owned power generation companies in China, which means that if this proposal is achieved, those power conglomerates will have, after consolidation, will have stronger bargaining power, so that we can see the power tariff is possible to be lifted up. So this is the marine sector macro outlook. So according to Douglas Westwood and IHS Energy, with the recent oil recovery has little or nothing to do with the offshore side, because you can see here the capex for the forecasted capex on offshore side is actually shrinking or flattish. That means moving forward, for those oil majors, they may not put much money into the offshore side. So we don't expect a significant recovery from marine side in the next few years. These are 3 investment theses, investment merits that we think that could be the catalyst to benefit Sembcorp Industries. The first one is the India operation. So currently there are two plants under operation, TPCIL and SGPL. So for TPCIL, 80% of its 1,320 megawatt of the total capacity has been contracted under long-term PPA. So these long-term PPAs means that TPCIL can sell the power with a higher price than the spot market price. So for SGPL, it commenced commercial operation in February this year, and currently the 388 megawatt capacity was under short-term PPA, which will be expire in May this year. So at this moment, the team has been working hard on securing other PPAs, especially the long-term ones. Hopefully, we will see some good news came out late this year or early next year. And also, according to the management, they will do the refinancing to lower the interest cost of SGPL to 13% or below. So for Singapore market, actually the power sector is loss-making at this point of time. However, the other business such as the steam, natural gas, or the wastewater treatment and on-site logistics, they can buffer the losses from the power generation. And also the low oil environment can benefit the operation in Singapore a bit because it will have a lower production cost. So for China side, because the utility segment is highly regulated by the government in China, so we think that the profit margin in China is kept at a certain level, but still it will provide a protection or a safety for a certain level of the profit margin. So here we make our own guess on the strategic review on the finance side. The first one is Sembcorp Industries can monetize the mature utilities assets via spinning out into the special purpose vehicle, UCO or business trust. That means that Sembcorp Industries can sell part of the mature or with stable cash flow generation assets to the SPV so that they can free up the room to invest the collecting funds to expand their portfolio in the higher growth area such as Middle East. And the second one is the demerged marine business via dividend in specie to existing shareholders. That means Sembcorp Industries can sell the marine business to the mother company via dividend in specie, so that the marine segment will be stripped off from the current portfolio. And the third one is the ultimate owner of Sembcorp Industries can privatize of the marine business. Then again, the purpose is to strip off the marine side from the existing portfolio of the group. So here we use some of the parts to value the whole group. So as for marine side, we already have coverage on Sembcorp Marine. So we use our target price with the current shares outstanding to derive the valuation of the marine business. As for the utility side, we use the weighted average price to book ratio to evaluate. So basically, we use 1.2 times of PB, which is the peers average power sector. So here is the peer comparison table. The reason why we use 1.2 times based on the power sector is because quite significant amount of the assets and operations are weighted in thermal power generation of the group. And also you can see the whole group's ROE is 7%. So the utility segments, we did our math to derive the ROE from the utility size is around 8%, which means that the utilities are traded at a higher premium due to its superior ROE of 7%, which is the peers from India and China market. So we derive our target price of $3.50 after 10% discount after 10% discount, and the discount is for the conglomerate discount because for this conglomerate they may not generate a positive synergies among those segments that they operate across different regions. So here are the investment risks. So basically the risks bear in the Indian market as for now, because if SGPL fail to secure PPAs moving forward, especially the long-term ones, that means the current startup issues will be continue, and accordingly the SGPL's performance will drag down the whole group's portfolio. Here is the recap. So our target price is $3.50 and forecasted dividend is 8 cents. So here is the end of our presentation today. Any questions? So there is a question asking about what's the current price of the thermal coal. So based on the closespotprice.com as well as the disclosure from Geo Energy, the ICI 4002 GAP was trading at around $37 per ton as for now. So the first quarter, the hike was around $44 per ton. So you can refer to the screen here, coalspot.com. So if you register an account, you can see the reference price from India side. Here is the coal index, the ICI, Australian, Colombia. So there is a question asking about how come the capex on offshore on the top chart here is different from the chart below. So you can see here the for those capex on offshore actually is shrinking moving forward. You can see the area is smaller year by year. So here the forecast from IHS Energy is that it may be flattish or slower growth on these global E&P offshore capex. So the major part here is that the recovery actually comes from the capex from onshore.
Hi, good morning guys, Teo Hong here. There's a question on REITs and the question is whether REITs are looking attractive now. Our sector views on REITs still range from neutral to underweight, and our basis for these ratings are because firstly of the broader macro environment. We see that from post GFC until like 2014, we have been having accommodative monetary policies. Now we're moving towards a gradually tightening macro environment. That is one. And then the second point is that on top of this gradual tightening environment, we are also seeing that the specific sector headwinds in terms of if you look at Singapore retail REITs and commercial REITs, they are facing negative rental reversion pressures as well. So from a macro perspective as well as a micro perspective, we do see that the the REITs in Singapore are continuing to face headwinds. That explains our broad sector ratings. But then that being said, we on a bottoms up perspective, we do see certain REITs having favorable perspectives. Some of them with exposure to overseas markets. So right now for us, the the two REITs and business trusts that we still have buy ratings or accumulate ratings are APTV and Croatia's Retail Trust.
There is a question asking about whether the onshore capex is mainly referring to the shale producers in US, and our answer is possibly, because as we knew that the onshore production cost is much lower than the offshore one. So based on the current market research, the shale production cost has been lowered to like average $50 per barrel. So we think that with the development of the technology, we could forecast that the shale production cost uh, could be even lower in the next few years. So there is another question asking about whether more investment in onshore means more oil from shale producers. So the current market situation is that the shale producers is fighting for more market shares with those traditional onshore oil producers such as OPEC. So the increase in investment on shale oil is certain, but whether they will pump more oil, it depends on whether the margin for them is favorable or not. So if there are no more questions today, we will end our webinar here. Thank you for tuning in and we'll see you next week.